You've no doubt heard about whole life insurance and indexed universal life insurance, which is fastly becoming the most popular insurance that's sold today.
You are listening to Wealth Talks, Universal Life Insurance versus participating whole life insurance. We've talked about this before, and I wanted to come at this from a unique angle this time. So we looked up some arguments that are common on the indexed universal life side, saying, there's a lot of bashing on both sides. For the whole life guys go after the IUL go after the whole life, saying that each has the better product here. So we wanted to look in depth at some of those arguments because some of them seem like they're really level-headed, reasonable as you listen to them or read them on the internet. What's really going on here? And let's take a deeper look at these arguments and see what's really happening in the big picture.
And before we do that, I just want to remind everybody that we're not into bashing anything. We are here to expose the truth because we've never met anyone that isn't brilliant enough to come up with the right decision for themselves once the truth has been explained to them. But what's wrong is sales pitches. And I just want to start off this whole conversation with the fact that any company and every company that I represent to sell insurance with, when I've asked them, why do you sell indexed universal life? Their answer to me is it takes the risk off the company and puts it back onto the policyholder. That alone, for me, is something that I don't want to expose my clients to, because insurance is supposed to avoid risk, not absorb the risk of the insurance company.
Certainly. Yeah.
And so let's explore why the IUL arguments, though they sound reasonable and logical, fall apart based on that fact.
Absolutely. So one of the common arguments is that the people who are on the whole life side bashing the IUL can't sell IUL. So that's why they go ahead and bash it. Well, that turns out to be that a lot of people choose not to sell it, like us. The companies that we represent, many of them have an IUL product.
And they push it. Every time those marketing agents come by to visit the office, they say, well, have you checked out our new IUL product? It's this, this, and this. And I always ask them the same question. How much indexed universal life insurance do you own personally? And their answer is, oh, well, I don't own it personally. I own whole life. But this product is really neat and good, and it's making the company lots of money right now, so maybe you want to look at it.
Yeah, we chuckle about it when these insurance company salesmen leave. They want us to sell this product. It's making money for the company, and they think, people are excited about it because it's a way to get some guarantees, they think, but still have a foot in the market.
Yeah.
And so I think that's the lure of the product, and the fact that some agents that can only sell whole life might be bashing IUL. That's beside the point because it doesn't apply across the board. There's many agents who can and choose not to. So
yes, in fact, it would be easier in a way to sell IUL because of the great speculative non-guaranteed values that you can illustrate in an IUL policy. It looks phenomenal on paper.
It does, and that's one of the problems with IUL, that even some of the pro IUL salespeople that you'll find out there will admit is that the illustration regulations around IUL, even though they have been cut back recently, IUL still benefits from a very favorable, too favorable, you could argue, provision on the projections that they can show on these illustrations.
And one of the reasons is they go back way too long in the history of the markets to get their data. If we go back 40 years, yes, you can get 8-9% return in the market. But if you are only going back 20 years, you can't get those type of returns. And so a couple of the companies we represent said you can't illustrate an IUL product anymore for more than 6% on projected values, which is still too high because
for many cases,
IUL products do not benefit from the dividends in those indexes. And if you take the dividends out of the S&P 500 over the last 20 years, you're barely breaking 4%.
Yeah, so it cuts it quite a little bit.
Yes.
So with the, one of the arguments that the IUL camp will say to come back against the whole life is, it depends on how you're using it. There's some agents that even sell both, that say the whole life is better for the guarantees. They recognize that all across the board. Whole life is better on the guarantees. But what about chasing some of these market returns?
Well, there's an old saying, you got to give people what they want before you can give them what they need. And maybe there is some truth to that when you're talking about people that want to have kind of the foot in the market type mentality that IUL markets to. Mm-hmm. However, it seems that when you have a person in the middle, that there is always a cost to pay the middleman.
There is, yeah.
And the whole idea about insurance is to avoid risk. It's not about investing. And that's why variable life insurance, you have to have a securities license to even sell the product anymore, because people were misunderstanding that it was an insurance product when it's actually an investment product. Mm-hmm. Now, when we're talking about indexed universal, you're not per se investing, but there's a valid point to be made that you would be better off buying a smaller whole life policy and investing the difference directly in the mutual fund or the S&P index.
That's what I've never been able to figure out. Why wouldn't you do that?
Well, because you want some type of protection or shield that just isn't being provided by going through an insurance company to make that happen. The IUL products were really an answer by the insurance company to the old saying, buy term and invest the difference. Because as we know, all universal products are made up of a base term insurance product. And that product has an increasing premium that has to be met. And it's either going to be met with the interest you earn off of the return of the market, mm-hmm. or it's going to be paid out of your pocket. That's the only two ways it can be paid. The insurance company is not going to pay it for you.
Absolutely. And that's one of the reasons the insurance companies like this product. That's one of the ways that they are shifting the risk from their portfolio back to the customer.
That's correct. And of course, because it's based that way, they can charge higher fees to manage this product for you.
Well, that brings up another good argument. Some people will say, well, yeah, the fees are there in IUL, but they're there in whole life too. They're just behind the scenes. They're worked into the actual product. Whereas a universal life insurance, or particularly indexed universal life insurance, tends to unbundle this a little bit more and show you the actual fees that you're paying.
I would agree with that mm-hmm. to a certain point. When you're buying a whole life policy without any riders, then there is a flat fee. So let's say it's $100. I've never seen a fee higher than $100 on a basic whole life insurance policy.
$100 a year.
Yeah, $100 a year. So if I'm paying $1,000 a year for my premium, I still pay $100. That is a large percentage of my premium, isn't it? Mm-hmm. But what if I'm paying $50,000 for my premium?
It's a lot less percentage.
That fee is less percentage-wise. Sure. Whereas a universal policy, they're going to charge 1% of what you paid. So it's usually around 6%. So 6% of $1,000, is that more or less than the $100 fee on a whole life policy?
It's going to be more, depending on the size of policy. But if it's a bigger policy, it's going to be bigger.
The larger the policy gets, the more that fee becomes to you.
Certainly.
And, someone said, well, at one time, well, it's only 6%, but whose money is it? That becomes significant when it's your money. And that's what we're here to help protect, is your money, because we want you to keep more of your money, not lose more of your money.
That's right. Something else that comes up when talking about the differences between whole life and universal life insurance is the fact that whole life insurance is based on somebody's whole life, whereas universal life insurance, the insurance component is based on 1 year renewable term. So you have this ever increasing cost of insurance as that 1 year renewable term goes up. The universal life insurance proponents say, well, that's not really a problem because if the policy is designed correctly, then you're going to have less and less 1-year renewable term insurance factored into that every year because more and more is going to be represented in the cash value. What is the problem with this evaluation?
Well, what they're talking about is risk-reward ratios, really. And, of course, the more cash that you've accumulated in your policy, the less risk the insurance company has because they've got more money of your money that they're using to invest.
Sure.
But there's two types of universal policies. And we've got to look at that. There's type A and there's type B. Mm-hmm. And in type A, you have a limited death benefit that never grows unless you pay an extra premium on a rider to make that death benefit climb every year.
Okay, so that would be the most common option where they're saying, okay, so now that you have more cash value, we're not having to cover as much of the death benefit.
That's correct.
So that's similar to what happens in whole life automatically behind the scenes. It's where they're covering that insurance, they're covering their risk over time, and your cash value represents your equity in the death benefit.
That's correct.
Okay.
Type B, on the other hand, is it starts out with a lower death benefit. Mm-hmm. And it will grow over time, similar to a whole life. But the disadvantage there is that you're paying a higher premium earlier on for a lower amount of death benefit.
Okay.
And if the policyholder were to die early, then there wouldn't be the coverage that's necessary.
Now, so option B would be the one where the agent would tell you, well, with universal life, you can get the cash value and the death benefit. Your heirs do when you die, whereas with whole life, you only get the death benefit. That would be an option B universal life insurance policy, because an option A would be just like whole life as far as the death benefit payout.
But in that case, we have to realize that the money that is paying for that is your money.
Yeah.
So they're just holding
Higher
your
premium
money
for it.
to pay at the death benefit instead of letting you use it while you're alive. So it doesn't. That's not a real logical point. It falls apart.
It falls apart pretty quickly. Wow. So all of these arguments here, really, it's coming down to the difference between the guarantees that you have with the UL versus the whole life. And one of the things is that that comes up with this is people look at the universal life insurance policies that were sold in the 1980s and even the 90s when interest rates were higher, and they say, well, look at interest rates were high then, even the guaranteed rates were higher on these policies, and now they're falling apart because the premiums are going up in order to keep up the death benefit on these policies. These policyholders don't have any option out. Universal life insurance isn't any good. The comeback to that argument is, well, they didn't pay enough in premium because those rates were good. And if they would have paid enough in premium, then maybe it would have stuck around a little bit longer. What's wrong with that evaluation when it comes to the guarantees?
Well, the guarantees in universal life products are set by the insurance company, believing that that's what they could pay. There has been a $930 million payout to people whose universal life policies have collapsed.
Wow.
And that may not be the end of it. Mm-hmm. But when people buy a permanent product, they truly believe that they are buying something that is going to be permanent.
Sure.
That's going to last their entire lifetime. And that's where universal life, whether it's index variable or just plain vanilla, probably is misleading in its name. Mm-hmm. It should be classified different, in my opinion.
Yeah, not as permanent life
insurance. Not as permanent life insurance. But, then someone will say, well, whole life isn't permanent either if you don't pay the premiums.
That's true.
And that's true. That's the same thing with universal life, only we're not dealing with a flexible premium. Uh-huh. We're dealing with a level premium in whole life where all universal policies have a flexible premium.
So theoretically, you could make sure that you paid enough premium on the IUL or the universal life to keep up, regardless of what happened to interest rates. But you're taking a risk.
You are taking a risk.
Doing that.
You are taking a risk. And it all boils down to this. I just recently read a book that was given to me called Wealth Unbroken, and I'm not picking on anybody here, but the author of this book spends 190-some pages talking about all the wonderful things that IUL can do to build wealth for you. And then on page 195, she says, although IULs are vehicles that provide safe, strong growth and opportunity, we know that there will be years when the market will go down. So when we look to maximize growth as far as the legacy, we prefer to latch on to the compound yield curve in an uninterrupted way. Uninterrupted growth leaves us with only one option. That option is the stalwart of life insurance, whole life insurance.
Wow.
And that's the bottom line.
No match to the guarantees.
So I'm not here to bash IUL. There's even maybe an area where someone might be able to use it feasibly.
Okay. So maybe who would that person be? Like maybe
someone who doesn't plan to pay the premiums for much longer than 10 or 15 years, just to wait until the surrender value equals the accumulated value.
Okay.
And if the market has performed well over those 10 to 15 years, then they could take their money and run.
Okay.
But then you've got the issue when you go to apply for more whole life insurance or any type of life insurance. Have you ever canceled a life insurance policy? And why?
Sure.
Because the life insurance companies are in business to pay death claims, to manage your money and make money. And what they do with those premium dollars is they create profits so that they can pay mortality expenses. And what's left over is shared with participating whole life insurance owners. That's called dividend-paying whole life insurance. And you only earn dividends if you are owning a participating policy. And I've not yet seen a participating universal life policy.
Yeah.
The only whole life policies that are the only policies I've seen that are participating are whole life.
Sure.
And I want to participate in those profits because once a dividend is paid, it's guaranteed. It can't then be turned around and eaten up in premium as long as I keep paying my premiums. It can't be eaten up in interest as long as I pay any interest loans because the premium is level. It's not going to increase over the life of the contract.
Very good. So if we're to summarize here, with whole life, the premiums are not flexible, but they're not flexible, so the insurance company can promise you that they won't ever go up.
That's correct. They can go down, though.
Yeah, and all the complexity that life insurance is complex. If you try to unbundle it as they do in universal life insurance, it seems even more complex. In whole life insurance, they simplify it by keeping all that complexity in the background.
And that's one of the reasons the contracts are so small and concise in a whole life policy.
Yeah, they're guaranteed.
Whereas in a universal policy, they might be 3 or 4 times as big.
Sure. So you have really good guarantees in the whole life insurance. When it comes to the IUL side, premiums are flexible, which could give you a little bit of flexibility, but the guarantees are lower. In exchange, you're taking the risk that maybe if you do pay a lower premium, that you'll have to pay a lot more later to catch up. Lower guarantees, they're unbundled for transparency, but that in turn makes the risk increase for you. And we don't really have a way around it. Really, at the end of the day, it comes down to if you really want to be in the market with an IUL, have some market exposure, why wouldn't you buy a smaller whole life policy for the better guarantees and go ahead and invest in the index or separately? If you want to have a guaranteed floor or cap, that can be structured based on buying options on that index, which is what the insurance company is doing anyway behind the scenes, and they're simply tacking on a fee to it. The only benefit you wouldn't get in that case would be the tax-deferred growth on the entire policy, but you would also have more control and oversight over the process, whereas if you bundle into an IUL policy, you really don't know, you don't have that much control over what's happening. You don't know what's going on.
And like John Bogle used to say, the taxes and the fees you can pretty much eliminate. Inflation is the one that's really hard to get over when you're investing in mutual funds. So, you're going to face taxation. You may face fees, but there's ways to get around those.
There are. So do you think IUL will ever go away, or is it here to stay for at least the good next while?
Well, I think IUL will stay until it hits rock bottom like Universal did. Universal Life, just plain universal. Universal life policies are kind of rare to be sold anymore. We don't see very many of them. We sure saw a lot of them fail because of the high interest projections. I think we're going to see some we're going to see some IULs fail in the same way. And my question is to anybody that advocates universal life, how many people have you talked to that have run out of money in their policy? How many people have you talked to that couldn't afford the premium on a policy that they were buying to create an income for someone when they're gone? Mm-hmm. We've had many conversations with people that have faced those situations. It's not a pretty picture. Yeah. It's sad. And I don't ever want to sell a product to put someone in that position. So when I say there might be a place for an IUL product, I'm talking about someone that's using it for more of a business type situation rather than to try to leave a legacy.
Yeah.
It's just sad when someone was thinking they were going to provide a permanent product to a loved one, and when the time comes, there's nothing left in it.
Yeah. You touch on an important point there, the track record of these policies. The IUL really hasn't been around that long. Universal life insurance, as far as insurance goes, really hasn't been around that long, since the 1970s. And it didn't turn out so great. So we really don't know what the track record are on these IUL policies. We know that equity indexed annuities got a bad rap.
Yes.
And they ended up changing the name. They're usually called fixed indexed annuities now.
Same with the universal IUL product. It used to be called equity index universal. It got a bad name, so they dropped the equity and just left the index.
So index, they changed a few bells and whistles, called it something different. So what's really going on behind the scenes here? The track record isn't there yet.
It isn't.
But it's there on whole life, and we know what's happening year in, year out there.
And the reason that is that when someone takes and assumes the liability for a life for 50, 60, 70 years, those products haven't been around that long. Mm-hmm. Whole life insurance has been around for 150, 200 years. We know the history of it. We know how it's going to perform. And so it just provides more stability. The insurance companies, I like to say, only sold whole life because it was a consumer-demanded product. Term insurance is a moneymaker for the insurance company because less than 2% of the policies ever pay a death claim. Why would you want to build a universal product on something like that?
Yeah, right. I don't see any reason to do it. The one final argument about index universal versus the whole life insurance. People say that you can compare a good whole life policy to a badly designed IUL. That wouldn't be a fair comparison, right? We've reviewed a lot of policies. We've reviewed, yes, there are bad whole life policies as well. You can design bad whole life policies. You can design good or bad index universal policies too. There are different things that can be done to minimize commissions or maximize commissions on those. But we've reviewed a lot of IUL policies, and I've never seen one that would be better than going with the whole life route, that I would rather give up the guarantees in order to try for the possibilities.
I'm waiting for that to happen. I've never seen it happen yet. And like you said, John, we have reviewed hundreds of indexed universal life products. It's, maybe it'll happen to me sometime in the future, but until it does, I'm going to stick to my guns that if you want guarantees and a legacy, you stick with whole life insurance.
Absolutely. So if you want us to review a policy that you've come across, maybe you own it already, and you would like us to do a review for you, you can give us a call at 702-660-7000 and ask for a policy review. We'll be able to help you with that. You are listening to Wealth Talks with Dr. Tom and John McPhee, bringing you the facts so you can thrive in life. Have a wonderful week.